Hi, welcome. Welcome to Dorchester Advisors. Thanks for joining me for this quick market update about the first quarter of 2026. I think you'll get some valuable investment insights. Now, in case we haven't met before, my name is Dushyant and I'm the founder and managing director of Dorchester Advisors. Here, we work with individuals and families and help them build solid retirement portfolios that are capable of providing enough income to sustain their lifestyles through their retirement. Quarter 1 of 2026 was a reminder that markets rarely move in a straight line. After reaching new highs in January earlier this year, equity markets pulled back, and at the same time, other asset classes like commodities and real assets, REITs, behaved differently. During the first quarter, US and global equity markets declined modestly. The S&P declined over this period, and overseas markets followed a similar path. Meanwhile, commodities and certain real assets like REITs moved higher, and bonds were slightly flat. This kind of divergence across markets is not unusual, but it's important. It reinforces a core principle of investing, that diversification matters. Not because it eliminates volatility, but because it helps to build portfolios that are resilient across different market environments. The point is, a diversified portfolio is rarely at the top of its class, but it's rarely at the bottom of its class either. What made this first quarter particularly notable is the speed of change. Markets started the year with strength, reaching new highs in January. But later in the quarter, the sentiment shifted. It shifted because of the geopolitical tensions in the Middle East. It shifted because of rising inflation, all these impacting energy prices and hence a lot of the American sentiment. This contrast between optimism and concern is a normal part of investing. Markets move between extremes, but over time, they tend to revert towards the more historical, trend-like outcomes. And this leads to a very important point. It is rarely useful to extrapolate short-term conditions into long-term conclusions. Reacting to headlines, whether driven by fear or optimism, leads to poor investment decisions. Now, while we are sensitive to different environments, usually our approach does not change in environments like this. For long-term investors, discipline remains our priority. Staying invested through volatility has historically been more effective than attempting to time the markets. And for clients drawing income from their portfolio, the structure is slightly different. We maintain allocations to more stable and liquid assets for such clients so that their withdrawals can be supported without impairing their long-term portfolio growth. And for all clients, portfolios are intentionally diversified. They are diversified across asset classes, sectors, geographies, and company sizes. Because the reality is simple. No one knows where future returns will come from. Our investment philosophy remains consistent. Be sensible, be prudent, and be cost conscious. This approach has worked across many investment cycles, many market cycles, and we believe it is still appropriate. While portfolios will experience fluctuations, they are designed to participate in the long-term economic growth, while maintaining risk along the way. If recent market movements have raised questions in your mind about your portfolio, your income strategy, or your overall financial plan, this is a good time to review things. I encourage you to reach out if you'd like to discuss how your portfolio is positioned in the current market environment. Even when no changes are needed, the clarity and alignment can be a valuable outcome. Thanks for visiting. I invite you to look through our website, and if our approach and philosophy resonate with you, hey, give me a call. I love talking all things investing.